And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It's, of course, Hump Day. It's the Wednesday edition of The Real Investment Show. Glad you're here to join me this morning as we get ready to wrap up the year. I mean, this is already the 14th of December. It's just like going right past us. Of course, today, yesterday, of course, the big day, inflation, right? Inflation came in weaker than expected, right? And that was good news. Market started off very strongly yesterday morning, up almost 3% at the open, and then sold off all day long. Market did finish positive yesterday, but that's a wicked bad red candle yesterday. So again, not only did we go back below the 200-day moving average, we also continued to hold that downtrend line ever since January. So, that was, it was a good day from the standpoint that the markets did finish positive. Wasn't a great day in the fact that we sold off really most of the day. So again, the realization is that, look, yes, inflation's coming down. Let's rewind the tape here, folks. Let's go back to April and May of this year when we were talking here saying, look, inflation is going to peak and it is going to go lower this year, when everybody was saying inflation's just going to go to the moon. It's like, no, year-over-year comparisons are going to make inflation come down, and that's exactly what's happened. We're at 7.1% inflation. That ain't cheap, right? In terms of what the Fed is looking at, 7.1% is still a very high level of inflation. But yes, inflation has peaked as that monetary pig of all that money we put into the economy back in 2020 is exiting now the economic python. And so we're going through that process. Inflation will come down. It will go down lower next year. Yes, the Fed is going to slow the pace of rate hikes. They've hiked an inordinate amount since the beginning of this year. We had a 25 basis point hike in May, followed by 50 basis points, followed by 4 75-point rate hikes. Yes, the Fed is going to slow their pace of rate hikes. That does not mean they are going to pivot. What is a pivot? A pivot and a pause are two very different things. A pause in rate hikes means that they're just going to stop hiking rates, and that is going to eventually happen, right? So most likely the FOMC meeting today, we get past this, thank goodness, we don't have one until February. So the FOMC meeting today, Jerome Powell will likely restate what he's been saying, is that inflation is the primary concern. We are going to get inflation down. We are going to slow the pace of rate hikes now and kind of see how these rate hikes work because of the lag effect of rate hikes. Expect 50 basis points today. I would expect some fairly hawkish language coming out of Jerome Powell this afternoon following the mistake that the markets made back in 2 weeks ago at the speech he made at the Brookings Institute, where he said, hey, we're going to pause the pace of rate hikes, and the market took off 3.1% for the day, easing financial conditions. Of course, then Nick Timrose had to come out and then, of course, correct the markets that following Monday, saying, no, that's not what the Fed said. They're going to slow the pace of rate hikes, but inflation's still the key. Markets sold off, gave up all of that gain. Same thing here. 7.1% inflation is not where the Fed wants to be. They are going to hike rates until they get that rate down to 2%, and that is a long way from here. That won't happen until mid to late next year by the time we get there, depending on how fast inflation really starts to come down here. But the important thing here is that we're going to have 50 basis point hikes today, more rate hikes next year. And as we said before, 50 basis point rate hikes historically is a very aggressive rate hike. It's not 75, right? But 50 basis point is still very aggressive in terms of hiking rates. That is an impact to the consumer in terms of higher borrowing costs. And all these rate hikes still have to come through into the system next year. That's going to be the risk as we get there. So, maybe the market's figuring this out. Maybe the market figured it out yesterday with that 3% jump, saying maybe, let's not get too far ahead of ourselves. The Fed is going to be hiking rates. But again, look, good news. Despite the fact that the market did, finish up yesterday, still in this consolidation range, we tested the 20-day moving average yesterday, bounced off that During the day, we sold off to it, bounced off of it, closed a little bit above it yesterday, still below the 200-day moving average. All that resistance still kind of intact for right now. Market, despite all the movement around, markets haven't gone anywhere now since going all the way back to about November the 8th. So since November the 8th, markets have gone nowhere. We've just kind of been stuck here ever since we had that 5.5% jump on that last reading of inflation that was weaker than expected. We've gone nowhere, just trading sideways at this point. Now, here's all the good news. After today, we get the FOMC meeting out of the way. I don't know what's going to happen. We'll see what happens with markets. Friday, we have $3.2 trillion worth of options expiration. That's it. Once we get through Friday, we've got 2 weeks of bliss going into the Christmas holiday season. Santa Claus rally, of course, right around the corner. That should get us through the end of the year. Hopefully lift markets back up here. New target now after yesterday's open is 4,100. So that is potentially the top end of that range at the moment. But we could get a rally into the end of the year. Then the first couple of weeks of January. January has more money flows combined than every other month of the year, all combined. And the reason for that is all the money coming in for the new year, 401k contributions, all that matching, everything that happens with pension plans. So first 10 days of January tend to be seasonally very strong. So again, we've got a kind of a 4-week stretch here where maybe we get a little bit of a reprieve from some of the selling, get a little bit more upside in the markets here near term. We'll see how this kind of shapes out. Today, though, of course, get through the FOMC meeting. That'll kind of give us a basis for, where we can kind of start looking. If we want to try to add some trading exposure, maybe we can. The MACD sell signal still very elevated here, but it's not uncommon for it to even trigger a buy signal again, even from an elevated level. That'll give you a short-term kind of a trading run potentially, but again, it'll be limited because a lot of these indicators are still very overbought short-term, and particularly after yesterday, it pulled a lot of these indicators up. Our previous oversold indicator now already pushing back up towards overbought levels. So upside will be somewhat limited, but there will likely be some upside depending on what happens today. Now, again, I really don't have any clue. At 2 o'clock today when the FOMC makes their announcement, this market could be up 3%, it could be down 3%. I mean, it's just depending on how hawkish that language actually is coming out of Jerome Powell. Let's see how we finish out today. I would remain a little bit cautious on allocations. Whatever happens today, happens today. And then we can kind of reposition and rethink our strategy in terms of allocation as we get through today and start heading into that last couple of weeks of the trading year where you have light volume. Basically, everybody leaves and you have inmates running the asylum. So we'll get through that. Okay, outside of that, of course, inflation, FOMC, get that behind us. Other things that we're going to be paying attention to, earnings right now. So, stock buybacks have been helping support markets so far. That's been a very strong push. But earnings are going to start being important once we get into January, February, March, right? So this is December. We're wrapping up now the fourth quarter. We're going to get into earnings season right around the corner. I know we just finished earnings season, and here it is again. So millennial soccer right around the corner. Estimates have come down. Everybody gets a trophy. So get into January, we'll start getting really kind of the reports on retail sales, what's happening in terms, really kind of get that good, kind of first view of the consumer and consumption. Of course, that's 70% of the economy. But we get into January, we'll start getting those reports about how good Christmas sales were or maybe weren't. We'll get there. A lot of stuff to get into today, of course. Danny Ratliff joining me, Certified Financial Planner. We'll be right back after the break. Michael Leibowitz's new article, very good article today on the website, realinvestmentadvice.com. Go get that now. We'll be right back. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive. as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
This song kind of gets me grooving this early in the morning. Danny Ratliff joining me this morning as well, fresh off of the FTX scandal. Hey Danny, what's up?
That's a heck of a lead-in. So where are you going with this one, Lance?
So speaking of that, so yesterday, of course, we were discussing the FTX scandal yesterday morning. Of course, at that point, we were waiting the charges to be released against Sam Bankman-Fried. And we kind of went through those yesterday and, what that all means. Of course, yesterday afternoon, big announcement. I was supposed to do Fox Business News at 2 o'clock sharp and got delayed till 2:45 because that was exactly when they were actually announcing all of the charges, both civil and criminal. This involves the SEC, the FBI, the CFTC. I mean, basically everybody is involved in this investigation. Sam Bankman-Fried, of course, arrested yesterday and denied bail. He's a flight risk. So he is now in jail until they can get him extradited to the U.S. So, this is having a broader impact. But here's the thing that we want to kind of recap here a little bit. And we touched on this yesterday. History is very important. And again, when we talked about the fact that back in 1929 there was kind of a Wild West in investments, and there was no SEC back then. There was no regulatory environment over the markets. And of course, the peak of that market in 1929, of course, you had the Ponzi scheme with Charles Ponzi. We put in the SEC, we have formed regulations. Market worked great until, 1995-ish, 96. We started relaxing all of the regulations again because Wall Street was, at that point, Wall Street and banking were two separate things. And Wall Street had, you could either be a brokerage firm and you could trade in equities, or you could be a bank, but you couldn't do both. In the late 90s, we started fudging the rules and allowing banks and brokerage firms to come back together again. And, that accelerated post-2000 because banks were complaining. It's like, oh, it's not fair. It's not fair. Why? That the brokerage firms can make all this money doing IPOs and everything else. And we're just stuck here, giving out free checking accounts. So everybody's like, okay, fine. Y'all can go play together again. Lo and behold, 2007, we have a bust, and we have Bernie Madoff with the largest Ponzi scheme since 1929, right? And so, but here's the point. I'm not saying that there's certainly some elements to Sam Bankman-Fried in terms of being a Ponzi scheme. They were using client money to solve other problems. That's kind of the essential basis of a Ponzi scheme. But, again, the point here is that we in 2020, here we go again, flooding the system with all kinds of liquidity, creating a lot of speculative appetite, too much money chasing too few assets. And we warned then. I wrote articles talking about the fallacy of pet rocks. People were buying digital pet rocks, in the metaverse.
Virtual real estate.
Virtual real estate, all this type of stuff. Too much money chasing too few assets. And this provides the basis for frauds to be developed, right? And as always is the case, you have to be responsible for yourself. The SEC, God love them, right? They go after small guys. They go with that low-hanging fruit, right? They audit, small little brokerage firms and, RIAs, et cetera, and, they'll get a fine every now and then. It's like, oh, yeah, we got this guy for $2 million. They miss the big stuff, right? Because they don't get involved because, again, if you're going to go audit or try to go after a Goldman Sachs or a Bank of America, and this is why whenever there's a crisis like we had back in 2008, right, clear violations of security laws all across the board by Bank of America and Goldman Sachs and others, and they got off by paying penalties, right? No declaration of anything, of any wrongdoing. They just paid some penalties and fines were basically just a tax. That was the cost of doing business for the billions they made in issuing fraudulent mortgages, right? So they paid a cost of doing business. And then President Obama at the time made it even easier because they said, oh, we'll cut your fine in half if you'll donate some of your fines to these political causes that we like. And so that provided funding for La Rosa and some other organizations and got fines cut. So it made it even more favorable for the banks to be a criminal enterprise. Saw this with Wells Fargo, opening up accounts for people that didn't want accounts open. But this goes on, right? They can't ever get the big guys because the big guys are lawyered up. They have, and if you're at the SEC and you want to go work for a big firm, you don't go after the fish you're going to go work for eventually. And, we even saw this with FTX. They had, former counsel, working with them. So the problem is we never catch these things in advance, but after the fact, and here's the point of the whole conversation. So here, easy money creates the environment to have a fraud. Now, after the fraud is complete, and it's apparent to everybody it's a fraud. Now we go arrest the guy, we put him in jail, and now, and this was the important, so this is a long lead up to the important thing that was said yesterday by the SEC. The SEC said, if you're not in compliance, you need to come talk to us so that we can get you into compliance. We can get you into the regulatory landscape. We can start regulating you. The whole point of Bitcoin was supposed to be, it ain't regulated, right? It's supposed to be totally anonymous. It's supposed to be outside the law. It's supposed to be this environment in which nobody's beholden to anybody, right? And we warned a year and a half ago that legislation was coming and that regulation was coming for these exchanges and these coins, and because they are securities, they will eventually wind up being securities, and they will wind up being fully transparent because the government wants control over these assets for safety reasons. And again, to protect consumers, because consumers aren't able to assess the risk they're taking. And, look, individuals have lost billions of dollars in not just FTX, but a whole variety of these, issues that have gone on because of too much speculative risk taking, because of too much money in the system. And again, when markets are going up, it's like, oh, what, I just throw money at it. I can't lose. It just goes up, and it's always going to go up. But this is where Danny and I talk a lot about risk management, understanding kind of what's going on. And, our job is to make money, yes, but our job is also to keep you from from losing so much money. And sometimes that means you can't chase these Wild West things because they always tend to end up badly. But, look, this is all going to have a very big turn of events over the next couple of years. We'll see a lot of this. We'll see a lot of changes to the crypto industry and really where it winds up. And, a lot of the initial fervor will be taken out because once it becomes a regulated environment, it will be much more difficult to bring coins to market, but it will also limit the upside potential for a lot of these transactions as well. So anyway, that's my rant this morning, Danny.
Yeah, but I think you make some good points there, Lance. But if you look back at any of these things, like you mentioned Bernie Madoff, you mentioned you didn't mention Alan Stanford, but you start thinking about some of the bigger Ponzi schemes or bigger issues where there's been true fraud within. There's always going to be bad actors, right? But these guys were operating not under the scope of regular business practices, right? I mean, you had Bernie Madoff, who was creating his own statements, had his own clearing firm on another level, that they were basically fraudulent the whole time, forging these statements, right?
Yeah, he was the broker, the accountant, and the RIA.
Correct.
Yeah.
And then you have Alan Stanford, who is the Bank of Antigua, right? And so sometimes when things are too good to be true, they likely are, and maybe that should throw up some red flags. But many times, and just like this with FTX, they're operating outside of the scope of typical regulatory environments. And so they're trying to catch up, which is another reason, like, we don't hold assets personally, right? We hold assets at a custodian. You want to keep that arm's length. And so I think it's always important to understand, where are funds? How are they being managed? What type of access do these people actually have to your funds? Because that's what this is essentially. And, I think it's interesting that the biggest news coming out of this Sam Bankman-Friedman deal is that, it's political campaign violations. That's what everybody keeps talking about.
Yeah. No.
Well, who cares? I mean, look, that's a big deal, I guess, right? But he took people's money. That's the bigger deal about it. Why is the headline that?
Well, the thing is he took people's money to make those political donations, right? So he was making political donations, by the way, if you didn't know, to both Democrats and Republicans. But he was using customer money to do that. And
then he was using other people's names. And he said all the Republican money was dark money, which essentially means that he was having somebody else go donate, and then he'd reimburse him, is what I read at least.
Right. Yeah, but that's going to be interesting because, again, now the question is all these political candidates that got money from FTX.
Yeah, what do you do? Are
they going to return it to the customers it belongs to?
Is it even still there?
Yeah, no, it's gone.
Yeah.
So, but the point is, and again, here's some. I know this is a bit of a rehash. We talked about this a bit yesterday, but this is kind of the news that's going on. But here's the things that you need to be aware of as an individual, because you're going to get presented with these things, from time to time. It's like, and you're going to get these things that are too good to be true. Let me give you a good example. People come out with, private REIT offerings all the time, right? And they come out and they say, hey, invest in this private REIT. It's going to give you a 17% annualized rate of return. I'll take that, right? 17%, right? That's a projection, right? These are, and I'm not saying that that's wrong, right? I'm just saying you have to understand what your risk is. It's all a projection. They don't know. And too many things can happen, right? You can have an economic downturn. You can have a whole variety of things happen. They can build a building and nobody comes, right? There are things that can happen that can greatly skew those very high rates of return. So just always you have to understand is, like, somebody offers you a really high rate of return, you have to ask, what's the risk? Why am I so lucky to get this? Other things to pay attention to. Never give somebody money that you're writing, like, you don't write a check to Danny Ratliff, CFP, for an investment portfolio. No, that should be to a major, well-established custodian, Charles Schwab, Fidelity, Interactive Brokers, TD Ameritrade. That's where your money's being held, where you have security, you have oversight, you have regulatory, issues.
And these are well-established firms.
Yeah.
They're not fly-by-night or up-and-coming that, I hope they're there.
So, but those are the things, the important thing is if it sounds too good to be true, it probably is. And even if it isn't, you may be not really missing out on all that much stuff, right? So it's better to be safe than sorry, as they say. All right, be right back after the break. Stuff to get into with Danny. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
We're looking for our next house eventually, right? We're driving and my wife's scrolling on her phone and she goes, well, there's an open house over here in this neighborhood. So she's like, okay, turn here. And so I turn on the street and she's like, okay, well, turn here. And I'm like, babe, where's this house at? You're looking at the open house on your phone. That's just, I don't have my glasses. I can't see my phone.
The Real Investment Show podcast
I had spent like 20 minutes driving around with a blind person giving me directions.
at realinvestmentadvice.com.
My life is a soap opera.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday and the latest analysis from Lance Roberts and Michael Leibowitz. Just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
There's a headline you don't see every day. Alaska State Trooper killed in Musk Ox attack. So,
Ew.
yeah. They do, you don't see that very often. Musk oxes as being, bears I get, right? But yeah, musk oxes.
Well, musk ox are a little different. You don't know how familiar you are with them. They kind of travel in herds. They're typically, they're not just going to be in, rolling through the neighborhood typically. So
yeah,
you got to probably get pretty close.
Yeah.
Yeah. So
my guess is maybe
I don't know the whole. Like I said, I don't know the whole story about what happened, but apparently, this is, it's a tragic accident that's occurred, but it's just something you don't see every day. Kind of in your headlines.
Not to be confused with Elon Musk.
Yeah,
Ox.
that's correct. Who, he has even said that he's at risk with
You think?
with what he's doing. He's also, Elon Musk is no longer the richest man in the world either.
Really?
Yeah. After yesterday's drop in Tesla stock, he has fallen out of the number one spot. So,
Do you know who is?
I think it's back to Bezos
Oh, okay.
again, if I'm not mistaken. I don't know.
Poor guy.
I didn't check. But yeah, I know if you're number two. I'm only number two richest man. I don't know. It might be Gates. He's up there too. But
Who?
Bill Gates.
Oh, Gates.
Yeah. I don't know. But anyway, I saw yesterday he dropped out of the top one spot.
Yeah.
So I'm sure he's ruining the day that happened.
Tough duty.
Yeah. I figure if you got $1 billion, you're pretty good. You're
just
doing okay.
one, right?
Yeah, just one. If you just have $1 billion, I think you're fine. Even after taxes, you're doing okay. It always cracks me up. People say, like the lottery's like $1 billion. Say, yeah, but after taxes and the lump sum payout, it's not that much money. Yeah.
Well, the funny thing is when the lottery gets really big, everybody's like, hey, we're going to go buy some lottery tickets.
Yeah.
I'm like, wait a second. Any of these would be life-changing for 99.9% of people out there.
I know. Hey, but when it
Even
was
the small ones.
but when the Powerball was 1.2 billion, my wife and I bought tickets.
Did you?
Yeah, had to. Just had to. You know, you never know. I didn't want to work with you anymore, so.
You know, the
I was
sad thing
hoping.
is that if, I would bet that if you won it tonight, you'd still be in here tomorrow.
Yeah, probably. Just because I love you, man.
If only
It's
to
all
pack
good.
up his desk.
Yeah,
Yeah. He'd be bored out of his mind.
I would be.
Well,
actually.
that's true. Yeah.
One of the things that you've also got to be careful of. We're talking about things before the break, with this FTX scandal, things you got to be careful of, right? Don't write a check to somebody for an investment. Make sure that where the money's going, it's supposed to be there. That's where it's supposed to be. Make sure that what you're investing in is what it really is. And, it's okay. Don't fall in love with projected returns because those very often don't turn out to be the case. You'll still make money. You just won't make, 20%. You might make 5, 6, 7, 8%, right? So, you're still going to make money most likely, and just make sure that have realistic expectations. But one of the other things you've got to be careful of is when the media starts telling you something, most likely and most often something else tends to happen. And now you remember that last year, everybody was talking about, the 4% rule, it's dead, right? Because when interest rates were at, on the 10-year treasury were at 0.5%, it was like, you can't take out 4% anymore on your account because, blah, blah, blah. Look, there's a lot of things that have changed. $1 million ain't what it used to be, right? Back in 1980, if you had $1 million, you could make 12% on your money. The cost of living was about $20,000. So you could live really well on $1 million, with what you could earn in interest back in 1980. $1 million today doesn't go that far, right? The cost of living for the average household family of 4 is north of $70,000 right now on an inflation-adjusted basis. See, this is the thing that everybody forgets to tell you. That $1 million, you got to inflation adjust that. And so, you see a lot of these articles on CNBC. It's like, here's how to get, this guy's a millionaire. He saved up $1 million. That's awesome, right? That's fantastic. He's better off than about 95%.
He's 30 years old and he's retired.
Yeah, you're 95% better off than everybody else. Well, that's all fine and dandy, except $1 million 30 years from now is not, the cost of living is going to be what? $100,000. And so you've got to generate 10% a year on $1 million to live $100,000 lifestyle. See the problem, right? This is the problem. We don't then, and these are the things that the media doesn't tell you. They all sound great. Just buy a bunch of index ETFs and dollar cost average. Have $1 million when you retire. It'll be awesome. $1 million is not going to be that much money 30 years from now.
Yeah, they forget to inflate it.
Yeah, exactly.
Imagine that.
Well, this is the same thing with the 4% rule, right? 2 years ago, 4% rule is dead. Can't do the 4% rule. You got to be all in equities. You got to have 100% of your money in equities because the 4% rule is dead. And guess what? The 4% rule is back. Because why? 10-year treasuries yielding almost 4%. Now, what's interesting is earlier this year.
They wrote this last week, though. It's 3.5 now. So
exactly. But earlier this year, Danny and I couldn't sell bonds to anybody. Nobody wanted bonds earlier this year. Now we open up bond sleeves and we've got this massive demand for bonds because everybody wants to own bonds now, right? So be careful about what the media tells you and don't extrapolate out, something to be the case forever because things always change. But again, yes, you're right, Danny. The 4% rule is now back.
They're changing quickly. And I think this is one thing to just keep in mind when you look at these things, because right now, so Wall Street Journal has a new article out. It essentially says the 4% rule for retirement spending makes a comeback. Well, just last year, the same people that did this research, so Christine Benz at Morningstar, they said, hey, it needs to be 3.3% because of yields are low, valuations were high. And now they're saying, well, because valuations are low, not because of inflation, not because of yields, actually, Lance. Mm-hmm. They're saying because valuations, now we can go in and say we feel much more comfortable at actually 3.8%, so close to 4%.
So, but where's she saying valuations are? She's saying valuations are low?
She said they're much lower now, so now we feel like that the wind should be at our back, but we know the valuations aren't all that low yet.
Yeah. They are down from 30 to...
They're way down from where they were, but
22 times earnings.
Yeah.
Yeah.
So, but I think the big thing is that, we always talk about take these things with a grain of salt when you hear these. And, I can tell you this. I've never had a client each and every year give themselves a raise. Say, January 1st, we're getting that 3.8% raise. Let's turn it on. Never have I had that happen. Now, typically, it's the conversation. We're going through financial plans. Hey, how's everything going? Check still hitting your account on the right time of the month. Is it still enough money? And usually what happens is, one spouse will chirp up and say, hey, you know what? I just don't feel like money's going as far as it used to. Or I feel like we're living paycheck to paycheck for the last week of every month. We just don't have enough. In fact, I had a guy, I've told the story probably in the past, that he used to eat ramen noodles. He would see for the last week, and this guy had plenty of money, he would see how much or how little he could spend in that last week of every month. It was a game to him. And, his wife said, this is nuts. And I said, yeah, I wish you told me about this a while back. We could fix this problem. But the point is that these numbers are going to change. They're going to be different for everybody. So what this rule of thumb, it's a traditional old school rule they created years and years ago, was that if you could take 4% out of your portfolio, so essentially you'd hope you'd be able to get a 4% yield, a return, those funds would be able to last for 30 plus years. And what they essentially do is that for inflation each year, you give yourself a little bit of a raise to keep up with inflation. Now, we stress plans. When we do financial planning, we actually assume that you're going to do that, but most people don't do it. But, we've actually seen studies, Lance, that suggest that number should be closer to 2.6 to 2.8 versus this much higher number. And, and if we're in this environment where everybody expects, you talked about in the first segment, this, maybe the pivot or it's just a stall and then a pivot, these yields aren't going to be here forever, so you better lock in while you can, right? I mean, if that's the case.
Yeah. Well, no, and this is, and again, when you go back and look at history, when that 4% rule was in place, interest rates on the 10-year Treasury were, 7, 8, 9, 10, 11%.
Way higher.
So you could take out, and the theory was you could take out 4, and then your portfolio would still be growing every year to adjust for inflation because you're not taking out as much as it's earning, right?
Correct.
And that's the whole thing. But again, that hasn't been the case for quite some time. But people forget that prior to 2008, 10-year the Treasury was yielding 6%ish, 5 and 6%, just prior to 2008. Post-financial crisis, we've crushed yields to basically nothing. And, now we're trying to get yields up to track inflation, but they can't even do that. And that's one of the big things. That's one of the big takeaways from all of this, right? We've got 7% inflation and the yields on the 10-year Treasury are 3.5%, 3.6%, right? Yields should track inflation. The yields on bonds have a long historical correlation to inflation and economic growth because that's what the economy will support. So if yields aren't tracking inflation, that tells you that the economy is not growing strong enough to support those higher yields, right? Because it's all about the supply and demand for credit. And so it tells you there's problems economically speaking, which we're pretty clear that we have that. But again, so just, like Danny said, though, these 4% rules and these rule of thumbs, they're great for just if you want to sit around the house and go, I've got this much money. If I could make 4% on it, could I live my lifestyle? That's a great little rule of thumb, right? Because hopefully we can generate 3, 4, 5, 6% rates of growth, in a year, depending on what the market's doing. But it's kind of a great little thumbtack. But don't rely on it. Don't go into retirement going, I'm going to get 4% every year because this year's a good example of that, right?
Yeah.
Nothing's really worked this year. Stocks are down, bonds are down, commodities are down. I mean, you name it. Nothing has really worked well. So you have to, and again, this is why Danny talks about stress testing plans. You have to account for these years where things don't work out as expected.
And what happens if, many people are stopping, they're slowing their spending down because of the environment we're in, but they're still spending the same amount of money.
Yeah.
Because everything costs more.
Yeah.
So that's an environment we haven't been in a long time.
All right. Be right back after the break. Talk about 4 steps to take if you lose your job, of course. Layoffs are picking up here. So what happens if that happens to you? Talk about that when we come back from the break with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. Getting ready to wrap up this Wednesday edition. Show about went by fast today. So of course, right now we're talking about potentially an economic slowdown in 2023. Layoffs, ticking up here. And the Fed wants this, by the way. The reason the Fed is hiking rates, and they've been clear about this, is they need the unemployment rate to come up to take wage pressure off, because wage pressures are part of the inflation equation in the economy. So they need unemployment to come up. So the big thing, of course, and I heard a financial guy this morning. I was driving in and listening to the radio, and he's like, you need to have 2 months worth of expenses in cash, in case you lose power at your house. You remember the freeze we had here in Texas? Mm-hmm. None of the ATMs worked. And this is the only problem with an all digital economy, is that, if somebody dropped an EMP somewhere, you're kind of toast. You can't transact any business at all, period, right? Because everything's digital. So he recommends 2 months of cash. I don't know if you need to really do that. I always keep some cash laying around, and my kid's like, "What's that, Dad?" And I was like, "This is called money. It's green and you can buy stuff with it." And they're like, "Nobody does that anymore, Dad."
Ours
so
is to pay the
old.
babysitter.
I know, right? But but there are some steps that that you probably need to take. And look, you may not think you're at risk of losing your job, and some people are clearly not at risk of losing their job, right? If you own your own business. But what happens if something happens to your business and it goes out of business, right? That can happen too.
You have a health issue, or you have other, or family members have health issues, and now you have to step away from the business. I mean, these are all bigger issues that you need to think about.
Just think about early, here, January, February of 2020. You're a restaurant, totally business, kicking butt, doing great, right? I'm not going to lose my job. I'm fine. Yeah. And then they shut down the whole economy, and you go out of business, right? And I'm just saying, and what I'm saying is that we need to these are things that we should all consider, because things can happen, right, that we don't plan on. And that's really kind of the important thing, right, Dan?
Correct. So I think some of the bigger problems that we don't address is that we typically address these when the event happens, whereas instead of actually preparing for it ahead of time. And so Rich and I have been talking about, having your emergency funds plus a financial vulnerability cushion for Lance, the last 2.5, 3 years?
Yeah.
It's been a while, and people have initially like, that's a little bit, too conservative for me, or, too aggressive on the savings front. And really, it's just about making sure that you're protecting you and your household. And so, if you are, I think that even prior to losing your job, if you have some time over the holidays, I'd start to assess your budget, understand exactly, where you are, make any adjustments that you may need, and think about what are the first places that you would cut if you did lose your job. I find that many times when we go through this exercise that many people find that they have a lot of, miscellaneous and other items they forget they're even paying for. So we've talked about this where, make sure that you understand all of those online subscriptions or things that you just get automatically. Are you actually using them? Do you take advantage of it? I mean, you see so many gym memberships, Lance, that are just, they're not used, 9 out of 12 months. And then January 1st, everybody, swamps the gym once again. So just the little things that can help you understand where that is. Evaluate your savings. Make sure you do have that. I think having cash on hand is not a bad idea in the event something does happen. We don't want to rule anything out, but also making sure that you do have those funds set aside and make sure that you're earning something. Look, cash is not trash like it used to be. Look, it's still not going to keep up with inflation, but there are many places that you can actually go out and get a little bit of yield on. In fact, I had a client send me a note yesterday saying that PNC Bank is now paying 4%. They increased that. We're seeing many of these institutions are actually paying you a little money. However, the big brick and mortar, those guys are still paying basically nothing. So be a little bit more deliberate with your cash. Understand where you're going to put it. If you're going to have some on hand, make it work for you. And so that's another idea or something that you need to do. Now, if you are retiring, or if, let's say, you get let go and you're near retirement, everybody says roll over that 401k. And generally speaking, that's a good idea, right? Because we're going to have much better investment options. You're going to be able to more proactively manage the funds. You're going to have control of these funds versus being in that 401k plan that typically is not going to give you as many options. But if you're under 59 and a half, there could be some benefits for you keeping these funds in that account, especially if you need to make a distribution. So what I'm really talking about is people typically between 55 and 59 and a half. Some of these 401k plans give you a little bit more leniency than your traditional IRA would. So keep that in mind before you just roll something over automatically, because that's what somebody says is the best thing to do. So you need to make sure you understand how you're going to pay your bills in the interim. And then, assess Social Security if you're over 62. Now, granted, we typically suggest and recommend that people don't take it prior to full retirement age. There are some times that, we can make an argument that you need to, right? It's just going to be, hey, you need it for cash flow. It's the only way you're going to live. Maybe you have an illness. Those are things that you want to consider. But in general, if you can delay, wait till your full retirement age. And if you can delay even longer, I mean, ideally, we'd prefer you wait till 70 or a little bit longer, just because you're going to collect that 8% between your full retirement age and age 70. And then you need to make sure that you're thinking about this not just for you, but for your spouse as well, especially if you were the high income earner. These are all considerations that need to be made where it is a family decision and discussion. And then have a plan in place. Have you done a financial plan? Have you updated it? What does that look like in preparation? I hear a lot of people, Lance, that come in and they say, listen, we just need help managing money. I don't need a plan yet. Okay, well, why not? Well, because I'm not quite ready, because I'm not near retirement, or I just don't think we need it. And the problem with that is that if you wait until everything is done, you're ready to step into retirement, we don't have any wiggle room to make changes that can help better prepare you for retirement. So a good financial planner is going to help you build out that plan way in advance. So it's going to give you that peace of mind. It's going to give you the ability to know you can walk into retirement and you're not going to be scrambling trying to figure out how you're going to make ends meet. And there's lots of ways, so a good financial advisor is going to not just to help you manage funds, but they're going to help you protect them from Uncle Sam, in the sense of there's some smart strategies we could be utilizing now while you're working that are going to keep more money in your pocket later down the road. And so we look at conventional wisdom, then we look and say, okay, what if we go a little bit different route that we can help protect those funds and mitigate that potential risk further down the line? And so we see a lot of times, a lot of people leave employee benefits on the table. They don't fully utilize that. We talked a little bit last week about how we had a client who, the way that the company was matching their 401k, they were maxing it out early. They were doing everything right, all the things that we were hoping that people do. But the way that they did it, they actually left employer contributions on the table from a matching perspective. And so being a little bit more diligent about looking at how these things are done, I think can help you out now to help build that nest egg, protect you and your family. And then if, God forbid, something happens, you do lose your job now, we kind of know where we go next. And that's one of the bigger things that I think that people don't address at the right time or properly. And look, I get it. I hear a lot of people say, I don't want to do a financial plan because I don't want anybody telling me how much I can live on. And that's not my job. In fact, I tell people, look, I want you to put down we're going to break things down. What are your needs? What are your wants? And then give me the pipe dream. Give me the thing that you think you'd never be able to do. What's some goal or something that you want to achieve or check off a bucket list? Then,
G4.
Yeah, okay, never mind. Not for you, Lance. But I want to try to help you get there and say, okay, here's the things that you need to do. And so this is why it's important to start working on these things earlier than later. And I think that we can't always do it, but there's been times that, we find ways and people are like, wow, okay, this is great. And so my job is not to tell you how much you can spend. Now I'm going to be your, financial counselor and say, hey, well, maybe you should cut back here, or maybe we should think about doing this a little bit differently. But, this is your money. You're going to do what you want with it. Our job is to make sure that you're making the right decisions along the way and just have an advocate to make sure that, you're being protected, you're making good decisions.
Yeah. And one of the biggest things that one of the biggest challenges for marriages in general is, there's always one of the, and you never know which one it's going to be. We meet with couples all the time. One of them is the saver, one of them is the spender, right? And one of the big things is, and Danny's right, the problem with financial planning is it has that nasty 4-letter word in it called budget. And that's always the challenge, is trying to get everybody onto the same page, to achieve a financial goal. And that's the hardest part. And the only way it works ultimately, and one of the biggest, I don't know if you call it a problem, but I guess we'll call it a challenge, is a lot of times, the husband will be taking care of the finances, or the wife will be taking care of all the finances, and the other spouse isn't involved at all, right? They don't even know where the money is. They don't know, what accounts are doing. That's a host of problems. One, if something happens to that person, the other person's like, I don't know where anything is, right? So it's important to have both partners on the same page in just terms of knowing where all the assets are and what's going on. But the other thing is that, financial planning and budgeting and all these things will work, but both partners have to be bought in, to that. And that what that means is that sometimes, the husband's like, well, here's our budget. We're going to spend, $3,000 a month to live on. And the wife's like, yeah, in your dreams. So you're going to have to come off that number that you're committed to, unless you just happen to have a partner that's bought into it with you. And find a level that works for you both, that you can both commit to, because that's the only way it works.
That's right. So on YouTube, The Real Investment Show, a lot of people are commenting in the chat box and saying, hey, I want to step in the grave and spend my last dollar, not have any money. Well, that would be great if we knew when our expiration date was, right? Nobody knows exactly when that is. And so we have to be diligent when we talk about how we're going to spend down money. And there's strategies to do so, but I know I don't want to be in some of these places they're going to put you if you don't have any money.
I know exactly the date of my death. It's the day that I'm going to burn in from a skydive with no parachute.
Nice.
It'll be a fun ride all the way down. Did you see that guy that jumped out of the airplane without a parachute?
No.
He actually did this. I think he set the world record for it, but he jumped out of an airplane without a parachute and landed in a net. That was out in Las Vegas somewhere.
Man, that's pretty gutsy.
Yeah. Do it without a net. That's what I'm saying. All right, that wraps up the show for the day. Danny, thank you so much. Of course, we'll be back tomorrow to talk about everything FOMC and Federal Reserve with today's meeting with Michael Leibowitz. So join us in the morning. We'll get you all the updates about where we're going to from here. That'll be tomorrow. Stick around. 3 minutes on markets and money coming up here shortly. Have a great day. Get by the website, realinvestmentadvice.com.